Welcome to the CNBC Debate. I'm Karen Cho, coming to you from Davos, Switzerland. Over the next 30 minutes, we'll be discussing an investment philosophy that looks to be measurable, beneficial to society and the planet, but most of all, still bring in healthy returns. The CNBC Debate on impact investing starts now. Impact investing, or sustainable responsible investing, has risen steadily, finding its place alongside traditional investing, where the focus is purely about financial return, amassing about $70 billion in assets, according to McKinsey. Big industry players, Bain Capital, BlackRock, Credit Suisse, Goldman Sachs and JP Morgan Chase are among those adding impact products to portfolios. But more effort is required to truly meet the UN Sustainable Development Goals in developing countries. This topic goes to the heart of the WEF theme this year, creating a shared future in a fractured world. Let me introduce you to our panelists today. Chuck Slaughter, founder of Living Goods. David Hertz, founder of Gastromotiva. Bill McGlasson, founder of the Rise Fund. And Axel Weber, the chairman of UBS. Thank you so much for joining us today, gentlemen. Let's start out with the concept of scale and talk about why it is so important to have money moving off the sidelines into impact investing. Perhaps, Axel, you can kick this off for us. Why is it important to have scale?
It's important to have scale because you want to bring mainstream investors to this endeavor. Because, we as a bank can bring private clients to impact investing, and that can make a difference. It has to develop from being a niche investment, which is very specific to each individual project, to projects becoming investable for mainstream investors. And I think that's where banks and financial institutions like us can make a difference. But of course, it needs all these guys and their good work so that we have projects to invest in, impacts to measure, and then financial investors to bring to these projects.
Bill, you run the largest impact investing fund. What's the gap that you see between where you need to be to achieve the scale across the industry?
Well, there's one way to think about the gap, which is the UN Sustainable Development Goals, which characterized a $40 trillion challenge that the world faces between now and 2030 to get to a world that we would all agree is a just world. And the gap annually in that figure is somewhere between $1.5 and $2.5 trillion. So if you think of the Gates Foundation as one of the largest in the world as a philanthropic foundation, that's less than 1.5% of the low end of the range gap in the first year. So absent serious capital getting involved in investing against both financial returns and social and environmental priorities, we're not going to get there. It takes funds like ours, it takes corporate investment and mainstream capital being brought to bear to fix many of the most intractable issues, which are frankly better fixed by sustainable, scalable business models than traditional philanthropy alone.
We have two entrepreneurs here who are going about the business of having an impact on the ground. Perhaps you can talk us through your experiences about access to capital and why big money is making a difference at this point.
Well, to get to the scalability, I think it's really important that we're talking the same level with you guys, because I think it's joining forces. And with UBS, we become visionaries, it gives us credibility, it gives us access to people that we never have access. And actually, it helps us to scale. But if I bring to my field, which is food, which I'm passionate about, we all can relate here. But at Gastromotiva, we are tackling the most important issues that we have to do: social inequality, malnutrition, getting skilled jobs in a hospitality industry that's growing a lot. So at the ground, we can train, we can support entrepreneurs, we can give food education. We are in 4 countries now, but to scale, we need a social business model that can really address these issues, and we can grow sustainable. So with IDB, we have this social business plan now that we just got $1 million, and we're looking for funds to match. But I'm sure we can really go for it and spread this to the global world. We have requests from Nigeria to Paris, so it's possible to do, but we need to find the common ground and partner and do it together, because we all get involved.
Yeah, I think Bill said it well. Scale is a must. You need scale to solve problems at the scale that they are in the world. And that's going to take an enormous amount of capital. If you think about philanthropy, a lot of philanthropy has had sort of a cottage industry sort of flavor, a charity flavor to it. And the trend I think we're excited about is philanthropy is becoming more businesslike. It's thinking more seriously about scale, about solving problems on a systemic level, rather than just funding little projects. And many charities like ours, Living Goods, which works in the healthcare sector, are increasingly actually using business models like ours to generate earned income that can make their social impacts significantly more sustainable.
Let's get into the how a little bit more then, and you've all been contributing to the UBS white paper that's been released here at Davos. The elements that were raised in the white paper talk about the need for collaboration, why that's so important for private wealth managers to work more closely with multilateral development banks, or MDBs, the likes of, say, the World Bank, ADB, and the like, pointing out that despite high returns promised, multilateral development bank debt is not widely held by private client portfolios. Why in this day and age, when everybody's chasing yield, is the money not going into some of these areas, Axel?
Well, for example, the World Bank, the IFC, many of the international development banks are government-sponsored entities. The owners are the governments, and they have capital and fund in the market, but their market programs have largely been geared towards institutional investors. And so the entire documentation of their debt instruments is geared towards institutional managers of risk that are looking exactly for that type of exposure. If you take the World Bank has a mandate to make and help make markets where markets themselves really abstain from investing. So they're really in the high risk business of bringing private investors in co-sponsored investments to markets that would otherwise not exist. And the risk appetite for that type of investment is usually with institutional investors. Now, our wealth management business, when we talk to the family offices, many of these family offices try and solve generational problems. So they want to invest for the benefit of the next generation, but also at the same time, they want to have an impact from what they're doing. And many of the millennials that are now in these family offices, are the biggest inheritance of global wealth, actually want to have a financial return, but also a society return and an impact. And that's why I think, our wealth clients are probably your best friends, because they're really long-term interested in solving long-term investment problems. And very often they're prohibited by doing that because the products aren't geared to their risk-bearing capacity or risk management capabilities. So you need to work on opening up your investments and your debt to non-institutional investors and bringing private markets there, and then later on mainstreaming that to become broadly investable products. And that's what we're trying to do.
The thing that I think that's exciting right now is with the speed of change and technology, there's so much more opportunity to make investments that can be very profitable and very, very impactful. And what's interesting, if you look at the disruptions brought by technology in media, in retail, in banking, in telephony, they've been massively disruptive to industries. But then you look at the sectors that are most important to human progress, healthcare, education, they've been late to the party. And I think there's a great opportunity to do investments in the next couple of years in healthcare and education in particular that can be just as transformative in those sectors, and that's where we focus.
We've been talking about a number of different investors here, and I think it's very well to talk about family offices that might be allocating some of their money to impact investing. If you talk about pension funds, a completely different ballgame. We've gone through a financial crisis where some investors have lost their nest egg. They want their money back, even if it's a slightly lower yield. They want the certainty of return on those assets. So how do you convince people that impact investing is low risk? Bill?
Yeah, so 70% of the capital in the RISE fund, in the 2.1 billion RISE fund, is institutional capital, and 60% of that capital is capital that's never before invested in impact. Part of our goal with the RISE fund was to solve some of the structural problems that had existed in the impact world, one of which was scale, and UBS is also an important partner of ours and helped solve some of that scale issue. A second challenge, though, was the notion that somehow there's a conflict between an impact priority and a return. And these pension funds and sovereign funds have a fiduciary responsibility to their constituencies, widows and orphans, to retirees, to manage the nest egg. So there can be no conflict, or there will be no impact investing. It has to be understood that these are collinear outcomes. So we demonstrated to them that we were investing in businesses where the output of the business is that which is creating the social or environmental impact. So the better, by definition, the better the business does, the more impact it creates. There is no conflict between the two priorities. This is not ESG. And then just the final point I'd make is everyone has used the word impact quite loosely. There's been a lot of work over the last decade by some of the pioneers to try to define what impact means so that you can underwrite it, measure it, report on it, and ultimately audit it. And we had to be able to demonstrate, and we spent several years working with Bridgespan and others, demonstrate that we could actually go into a company, understand the connection between the outputs and the social or environmental outcomes, underwrite the impact we would deliver in the form of an impact multiple of money, and then ultimately report on it. And KPMG is actually auditing and providing assurance around that impact, which means it's ready for institutional capital.
Here's the problem. I looked through the list of all the companies you've invested in so far in that space. I've never heard of any of them. That relies on me having faith in you to run the investment and faith in the auditors. I mean, let's face it, auditors have got it wrong in the past. So there's not a lot of transparency for the investor when it comes to this space. How do you solve that issue?
Well, this is exactly the point. I mean, the challenge historically has been, I can define anything as impact if you give me enough time. And it needs to be objective third party. So all of our impact measures are based on third party data. It has to be publishable third party data. And it turns out that Jay Powell alone at MIT has over 1 million studies that connect the dots between an output and an outcome, social environmental outcome. So it has to be credible and it has to be reportable at the end of the day. And again, our goal was, by pulling together the most important impact players with our founders board, Jeff Skoll and Bono and I set out to start this with that in mind. The most important institutional players, UBS, for example, who's been a pioneer in impact. Together, that capital is about $10 trillion. So there's a very good chance that when we're done, assuming we do our job right, that coalition of capital and influencers can effectively establish a standard that can be used by everybody. And we've committed to making it available to everybody to use.
I want to bring in the broader context because we are at Davos, and one of the big themes is around globalization versus economic nationalism. And if you think about the benefits of globalization, is that money has moved very freely across borders. But some of the messaging that's come through around Brexit and Trump's policies, more on the economic nationalism side. Comments from Trump most recently using a descriptive term when talking about migrants from certain African countries, from Haiti. I mean, they're sort of imaging this send when you're trying to convince people to put money into some of these countries. How big a negative is it? Chuck?
Well, look, I think the statistics is 6 of the fastest growing economies are in Africa. So putting aside personal prejudices, it's from a financial opportunity point of view, I think that's just a very short-sighted point of view. And what's compelling to me about some of these markets in particular is, take Africa as an example, some of the biggest innovations of technology, mobile money. Africa is probably not going to see retail banks. I'm sorry, Axel. And we think the same potential is there in healthcare, for example.
Bill, come in on the points here, because I know private equity has long screened out government policies and noise around governments. Is this the same issue, or is the mood music too strong on protest votes and economic nationalism, where you do have to be concerned about the approach to investors?
I think we're conflating in general in the world today 2 different big issues. Globalism is more of a statement around the concern many people have in the world about their future opportunity and their kids' opportunities. And, the mirror of all of the dislocation and growth investing that is now available to us is there are businesses being dislocated at an extraordinary rate. We're a large investor in healthcare. We're seeing now innovation coming in healthcare, but in media, retail, financial services. It's just an extraordinary time in that, particularly as a growth investor, we see opportunities to build very large companies in a very short period of time. But with that comes dislocation. And I think you've seen an expression of that in this, economic nationalism, globalism concern. And I think we all have to be mindful of the fact that in the context of the world we're all living in and the environments we're investing in, it needs to serve all people. We need to find a way to serve everyone. And that's particularly paramount for growth investors because we're the ones investing in that which is doing the dislocation. If you think of autonomous as an example, it's coming. The whole debate in the last election in the United States was about coal miners. That's 15,000 jobs roughly in the United States, and the trucking industry is 8.5 million jobs. So there's a tidal wave of dislocation that's going to require a whole lot of thoughtful, conscious effort on all of our part to address. And I think what has happened is it's a shortcut to all of that discontent is globalization and economic nationalism, because the immigration is being blamed, when in fact we can get away from religion when we get back to measurement and look at what is the value. You can quantify the value of mobile education, mobility and education, of immigration, and its effect on economic growth, and it turns out to be quite dramatically positive.
Axel, your thoughts on how globalization versus economic nationalism?
Well, look, if I look at the key risks that we're now facing, usually globalization is beneficial to everyone, and that's a starting proposition. You hear that in your standard macro textbook course. But actually, as we see the progress in globalization, it never happens in a straight line. There are periods where there is a setback for globalization. And the real issue is not do we need to push globalization further, but how do we deal with these periods where there is a setback, where basically the engine stalls, where people are starting to see that there are some winners, but yes, there are some who are standing on the side of globalization. And I think that's where sort of social responsible investment comes in, because we need to look at making globalization a benefit for everyone.
We have to close this out shortly. I just want to end on a tone about some of the threats, because we've spoken about a lot of the opportunities, how positive it is to invest, impact investing. Axel, what do you think is the number one threat to impact investing?
I actually think that as long as we focus on this really being a corporate endeavor where we do not create a difference or a distinction between the return on the investment, and we really keep this closely monitored. I think it's important to have professional outsiders monitoring. The biggest risk is you get people come in that don't really do what it is all about, and they bring a bad name to the business. So greenwashing is probably the biggest risk to engagement in sustainability. And so we need to be very cognizant that we have to have standards, and that we have clear definitions, and that we basically measure up everyone that does that and really divide the investor universe in something that is impact. And there is almost like a global quality seal for it. Once you get that global quality seal, we're in a better place. At the moment, a lot of people try and piggyback and mirror this, but they're not doing the same thing. So I think really establishing a standard for it would be the best way to preserve it.
Bill, quick line.
I think that and nuclear war with Korea are the two big. I'm kidding. I'm not worried about nuclear war. I do think greenwashing is a big issue, and I think we felt a tremendous obligation to demonstrate this returns point, because if we can't do it at our scale with the portfolio of resources we have as one of the largest investment firms in the world, it'll make a very bad statement. If we were to err and on the side of hyping impact instead of delivering real measurable impact on both sides of that equation, either low return or low impact, that would be a huge problem. So we feel a tremendous obligation to actually, and honestly, a real humility that we need to live up to what we set out to do here.
I think looking at Latin America's situation would be a lot of deregulatory, because there are no laws there to do an impact business, so it makes it difficult from all the sides. But for me, the biggest thing, and I see, is the timing for us to change the values in our society. We're talking a lot about, again, impact and business, but how do we all collaborate to change the values? It happened to me, it's happening to everyone that we're partnering, and it's a shift of the mindset.
Chuck, finally.
I think the risk is returning to the early days of impact investing, where the perception was you had to sacrifice returns to invest with impact. I fundamentally don't think that's the truth. I think it's the opposite is true. And I think we have to maintain a high standard on returns as a way to grow and keep the sector thriving. And again, one of the things I'm most excited about, you look at kids getting out of college and out of business school, they want their work to matter. They want their investments to make a difference. And I think that spirit coming into the working world and into the investing world is going to make all the boats rise with the tide.
Gentlemen, thank you so much for your time. I've learned a lot. I hope our audience has learned a lot as well. Please put your hands together for our panel for Chuck, David, Bill, Axel.
I'm Tanya Breyer, and that was just a taster of what you can find on CNBC Live. For more award-winning content, just click on the videos. And don't forget to subscribe to our channel. Thank you so much for watching.